Hi, this is James A. with Full Capital, and we've got Mark Allen with GREA. Mark, how's it going?
James, going well. Thanks for having me.
Yeah, thanks for jumping on. So you'll be at the conference coming up here in October. I want to bring you on and just have people get to know you a little bit better. So why don't we just start with sort of your background and give a little background on your firm and sort of here in Dallas.
Yeah. So I've been a longtime real estate investor. I went to West Point and they give a career starter loan because they know they're going to take it out of your paycheck when you go into the Army or the military. So anyways, I took that career starter loan and bought a rental property. And so that got me started. I ended up joining GREA. We were a different name at the time, back at the end of 2016. So I've been doing this for almost a decade. But GREA is a privately owned company. We have 12 offices across the country. We're multifamily specialized. So everything's heads and beds focus. We're an investment sales shop. And our Dallas office has, I think right now, 15 brokers. So we're one of the larger teams, but we bifurcate into sub teams where we have a secondary tertiary markets team. We've got a workforce housing team. We've got small balance team, which internally is 7.5 million and under. And we do some land transactions. So, anyways, we try to cover the gamut of all things multifamily housing.
And so you've been in Dallas for almost 10 years now. The uh, Take me through the cycle right now of sort of you can start in 2015 or you can start in 2020, wherever you want to start it, and tell me sort of based on what you're seeing, where are we right now in the cycle?
Yeah, so I guess coming out of the GFC, we had really compelling rent growth for many years, and I think all in all, interest rates and maybe were up and down, but generally like pretty stable in that 4.5 to 5.5% range for agency rates. We also had expense inflation as well, but prices were appreciating because we had strong rent growth, and maybe that ranged from depending on the submarket 2 to 10% plus over the years. COVID occurred, a lot of uncertainty with risk. It was pencils down for a couple of months, and then there was a lot of pent up demand, a lot of excess liquidity pushed into the market from the Treasury, and I guess with the help of the Fed, and so everything went a little bit crazy. Interest rates came way down, and all that pent up demand was put to work. Buyers started to go with bridge financing with variable interest rates. And so all of a sudden, the Fed started to hike rates because inflation ran hot and everything started to shift. So pricing has come down since end of 2022. It's been kind of I think initially in 23, prices came down 20% plus in the workforce housing space. I would say generally we're probably like 30% plus, depending on the deal, and B and C class housing. And I like to think that if you look at CoStar, if you look at Yardi Matrix, and I also looked at ALN recently, I think CoStar and Yardi Matrix had negative rent growth year over year. I think CoStar recently was highlighting that our just quarterly growth and rent growth was very strong at about 70 basis points. ALN had us actually at just positive for rent growth and a strong uptick recently. So I think that the thesis is of most is that supply has fallen off a cliff as far as new starts and new construction. We have continued strong fundamentals or demand side of the equation with population growth. Population growth slowed a little bit, but I think we were still at like 2.1% as of last year, and in the DFW Metroplex. So absorption is strong, and I think that everyone expects that rent growth will continue to tick up, and hopefully be positive year over year when we're looking in the rear view next year. So
Yeah,
and again, with rent, when we have rent growth, even if we have stable interest rates, I think we'll start to see price appreciation again.
yeah, that's what everybody's waiting for. So
Yeah.
we're waiting for, like, if you look at, I think it was Real Page, they put out like a monthly, either Real Page or Yardi, they put out like a monthly, month over month rents. And this thing has been just like it was huge in 21, 22, and now it's just been like now you're seeing like a little bit of life like on the for March,
Yeah,
and um that could be a combination. Like, both of us invest in a lot of real estate, but a lot of the monthly reports that I just got on the 15th, the retention's been a lot higher. So, usually it's 50%. Most of the reports that I saw for the deals I'm in, they're like 60 to 70% retention. And then on the renewals, people are getting anywhere from, 1 to maybe 4% on renewals. Just because that $25 a month, like nobody's moving for $25 a month or $50 a month.
yeah, yeah, because the
And
cost is too high.
yeah, cost is too high. It's just, I don't know what I'm going to do. I'll just renew. That's easy enough. Um, so we're seeing, I think, that blend shift a little bit where the renewals are higher. The new lease trade outs, though, I'm still seeing negatives on new lease trade outs right now. Um, but as you were talking about DFW a little bit more and maybe buyers coming into the market, like you guys have a good number of deals. I think the first quarter was there's a lot more listings on the market compared to 2024. Um, who is coming out right now on these tours, looking at these deals? Is it guys out of state? Is it local guys? What is your feel of the buyer pool right now?
Yeah, and going back to one of the first items that you noted, so listing activity was up in Q1. I would say for our office in particular, we had a slow Q1 as far as listing activity. So maybe not as much data points. We had, I think we walked into the year with 18 or 19 deals under contract. Um, and our thesis is that a lot of these deals take a lot more hand holding to get across the finish line, and so maybe that was impacting the pipeline a little bit. It's now starting to really pick up, but just some quick numbers on 60s, 70s vintage. We had 21 listings in Q1 of 2024 versus 31 in Q1 of 2025. For 1980s product, we had 18 last year versus 30 this year. So a lot more listing activity, but I've been, just kind of tracking some deals, having conversations with my clients that have listed their properties with other firms, and it seems like a lot of the 60s, 70s is still, again, it probably all comes down to motivation, but there's still some deals that are missing the mark on pricing. I think there's still a lot of sellers that want to sell. It's just, it's still a challenging environment, specifically for 60s, 70s, maybe not as much 80s, but every vintage type has a sweet spot. Uh, James, you and I were talking about got a deal out to market that's 27 million 80s vintage deal. And so it's like, maybe just a little bit big for, syndicators who are going to raise from friends or family, at least for most, where it's, call it, $9 million raise versus, the larger groups that maybe have single check writers, they tend to want to be 10 million and up. So it's a little bit of a tweener. So some of those deals might be a little bit challenging. But to answer your question on the buyers, I mean, generally, it's like we have new entrants into the market at all times. I just had a group that, is one of the most active single family, for rent buyers in the B and C space across the entire nation. And they're raising a fund to buy 20 to 100 unit B and C class housing, DFW, and some other markets that they own in. And so like we've got those kind of stories. We have the owners that own, 1,000 units over in, the Carolinas or something, and they're out in New York and they want to come here to Dallas. We've of course got, the typical 1031 exchange buyer that's selling a property in one of these core markets in the West or East Coast, and they want a little bit more yield and growth in Dallas. So generally it's a lot of the same type of buyers, but some of the syndicators have fallen on the wayside just because I think there's a lot of those that were active that are still playing defense and not ready to get back on offense. So that probably starts to shift, and I'm seeing that loosen up a little bit. Where some that were trying to get through the bridge loans and out refinance or whatever the case may be start to enter back into the market.
Yeah, so on those deals, we had a lot of listings come out, and buyers are giving, I think, real-time feedback to the broker and the seller, right? And um, as a seller right now, if you've got to go as a seller, how do you think you position yourself to sort of maximize the value that you go out at
Yeah.
in today's market?
You're-
Because,
So
like if you don't have to sell, obviously, kick the can, right? But if you do have to sell, what do you think is a couple points on maximizing sort of the value right now?
yeah. Well, if you're going to drive the most demand, which is going to result in higher pricing, there's a couple of different things. I think you're going to want to be stable and qualify for agency financing. I would argue that Dallas is probably the most liquid market in the country. We have buyers for just about every deal out there, whether there's absolutely no value add and it's a vintage deal, or if it's extremely low basis distress that's like a negative cap rate. But all that being said, I think the most demand for a deal today is going to be is going to be stable and qualifying for agency.
Okay.
So that's one
So
item.
focus on that.
Yeah,
if you before you bring a deal to mark, make sure it's 90% occupied on the rent roll, or that's the first thing
yeah,
that you're going to ask them to do before bringing it to market. Just because you don't
yeah,
want to waste anybody's time either, right? You don't want to take a
yeah,
deal to market. It's not stable. Someone has to do a bridge on it, and then that person's not, they don't want to take a low price, right?
right.
Because bridge money is still costing you, let's say SOFR plus three. So you're still paying 7.5 on
Hmm.
your interest rate right now.
Yeah,
Uh, so it's gonna that they're good. So they're gonna have to build that into the amount that they can offer on that deal.
yeah.
Yeah.
Right. And
Um,
then as far as pricing strategy goes, I mean, there's more deals on the market. And so you really got to track what's on the market, what are they guiding to? Because if I have an owner who, wants to bring a market or a deal to market at 100 a door, and there's a deal that's 3 miles away that just came out for 80 a door, that's similar, similar vintage and whatnot, it's going to be a little bit of an uphill battle. Again, we have plenty of buyer demand, so it's not like we're not going to get offers, but that could affect the deal. So I think pricing, and it's up to the broker to really craft a story. A compelling story is really important to get buyer engagement in today's market. And then again, just how they price it in general. Sometimes I feel like it's better to guide to realistic pricing. It's a competitive market, even for us brokers, and so sometimes you have a broker that's really aggressive on their pricing, and it can, I think, may go out to market, not get a whole lot of positive feedback, and then they end up chasing the market down, kind of losing any negotiation leverage.
yeah, because you just don't have the demand on tours. You don't have, people are going to do a quick underwrite on a deal, and if it doesn't work, they're not going to even bother to come out and take a look at it. And so they don't really ever hear the story. They don't get a feel for the property, if it's priced too high, right? So,
Right.
um, and then let's maybe wrap with this in terms of buyers coming into the market, or just like probably in the last couple months. I probably talked to like 5 to 10 groups that they're brand new and they have experience in this market, but it's been sort of under a different flag, right? They might be institutional guys starting their own shop or branching off of, another syndicator or something like that. How do those guys stand out in today's market, on a deal?
Yeah. I mean, everyone's going to be in a different position, right? I think I know one of the groups you're talking about. They came to the office to meet some of our brokers, and their pedigree is very strong. They got institutional background, and so I think something like that, probably really helps their position, especially as a brand new buyer. They understand, like, hey, we're not trying to go for a 30-40 million dollar deal for a first deal. Maybe that 10 to 15 million dollars, we feel really comfortable. Here's a story on equity. We've got a couple of high net worth investors that have said, hey, you bring us a deal that meet these returns, and we're in. So I think naturally for any new buyer, a broker is going to look at that as a little more risk, and so it's up to us to paint to the seller of what that risk is. It's a tough market to break into. You may not have that experience, and if you don't have that experience, it's okay. I think it's always better start small and grow up on larger deal sizes over time because he'd rather make mistakes on that 20 unit deal. It's probably an easier equity raise or whatever the case may be than maybe going in and after a $15 million deal on your first deal without much of a track record. So I don't know. There's a variety of different items.
Yeah, the irony is there is not a lot of distress, I would say, on small deals because a lot of the bridge lenders, they weren't going after those deals, and a lot of the syndicators, they bought their biggest deal in 21 and 22. And so there's probably more distress in that, let's call it 25 to $50 million range, like you were talking about.
Mhm.
More so than the $5 to $10 million range. And so yeah, I think it's a good idea to sort of get started in that space and then move up from there once you get your first deal done and you can point to that deal and have people go out to it. So, um,
Yeah.
but the conference coming up here in October. But if people want to get a hold of you beforehand, maybe talk about deals that you have coming up or what they're seeing in the market or what you're seeing in the market, what's the best way for people to reach out to you?
Yeah, we've got several listings out and several new ones coming soon. You can reach out via email is probably the best. Mark.allen@grea.com. You can always, find me on social media on LinkedIn or whatever the case may be. Our website is GREA.com. In the properties web pages, we set it up so it's very simple. You can see the map across the country and kind of focus in to the metro areas that you're most interested in and see all our deals.
Okay. All right. Well, I appreciate you coming on, Mark, and sharing some insight this morning. And we will see you in October.
Sounds good. Thanks,
All right.
James.
I see you.